Now, welcome back to segment two. Here, we're going to really look at demand. And as we talked about in the first segment about oil supply, how that started to creep up as the OPEC deal gets unwound to the second phase. We see some of that increase in production. But at the same time, we're seeing that reduction in total demand. And this is an interesting component. So when we were talking about Saudi Arabia, we said that we expected only an increase of about 560,000 barrels a day of additional exports, but it actually came in higher. And the reason why was because there was actually a reduction of what is normally used for additional electricity burn during the summer months in Saudi Arabia. So you can see for 2020, so far it's tracking along the 2018 numbers and really below that 5-year average, or I should say, for going from 2012 to 2017. So it's important to appreciate that they have been increasing the amount of natural gas usage, and there's just it's going to kind of go against what the common adage is in terms of, well, we're going to see a huge increase in oil demand. Well, maybe not. Maybe this is going to be kind of that new normal. Now, things have gotten hotter because it really varies of when is the hot month. Is it June, July, August, depending on how things shift. July obviously did get hotter, so it should increase, but it's really not going to increase to that 5-year average. It's going to kind of suck around that 2018, 2019 number, which is going to put those additional barrels into the export market, which again it's just showing you that demand is shifting. There is a different amount of demand versus what the expectations are. And this is just going to increase the supply more than what expectations were. And when we think about expectations for demand, you have to consider, well, what are the refiners doing? How are they operating? And that's why we focus so much on refined products. And we really want to talk with you about what is happening with refined product. Where do things sit? And this is just looking at Singapore as an aggregate. And this is going back to 1991. And here you can see we're at all-time highs. And all-time highs on a seasonally adjusted level. And this is why we keep seeing distillate coming from Asia into the Americas, into Europe, which is why we talked about that flow increase, because there's just such a glut over in Asia. And this is, even though we've seen some normalization in China, we've seen imports increase, we've also seen exports increase. And we've actually seen a huge drop in Indian demand as they have a resurgence of COVID, as the industrial areas start to slow down, but we keep seeing this pressure and it's appearing in product storage. And this is why you're going to have to see a little bit more of this glut get moved into other markets and to kind of normalize, because otherwise refiners are going to have to shut down further because they have nowhere to put the product. And the problem is we're heading into the shoulder season, which is why we keep getting this friction, which is why we do think there remains pressure that maybe should overwhelm the macro trade, which was short dollars, long oil, because oil still holds in. And it's really sitting here and just looking at just the general economics and the underlying. The physical market remains weak. The product market remains a glut. Refinery margins remain negative. So this is where we keep seeing this friction of kind of how is this going to play out. And you might say, well, a lot of it's going to China. Well, this is looking at just the Chinese Shandong crude storage. And here you can see, again, all-time highs. So this is another problem where it's, okay, well, where is this oil going to go? How is it going to be consumed? Because we are seeing refinery throughput walk back within China. But again, it's just going to be a matter of, well, how do they get it into market? Because there's some commentary that's kind of interesting coming out of China, because not only is there an increase in Shandong stock, but there's an increase just across China as an aggregate, which is why we do expect a big drop in their September and October purchases. Now, they have signed a bigger increase in imports from the U.S., but they're also bringing online a new storage facility. So the question is it really going into refiners and is actually going to be consumed, or is it going into storage? And there's about 30 million barrels of new storage capacity coming online. And if you look at what they purchased about 38 million barrels. So where is this going? Is 8 million going into refiners, 30 million into storage? This is something that we have to discuss, and we'll go deeper next week once we have a little bit more information, and we'll kind of factor that into the trade deal and where do they sit as we exit August. Now, this is looking at just refinery throughput. Now, in our Three Gorges Dam update, we talk about the flooding, we talk about the impacts, and again, that's going to impact not only diesel demand but also refinery throughput, because there are refiners in that area that are had to have their runs cut, and their runs have been cut closer to about 65, 62, 65, just because of not only the issues of getting feedstock to the market, but also just inherent demand. So when we first started talking about China really starting to ramp back up, we had said that the state-owned facilities wanted to maintain something closer to 80% or so, and if they could get closer to 83%. But you've seen now that they've really kind of fallen back to about 75%, which is going to have additional pressures just given where storage is. Now, the one that surprised us just based on context that we have was the view that independent refiners were going to walk back to about 65%. And we're just not seeing that because they are holding a closer to 73%. Now, does it go to 70 over September and October? The answer is likely, just given where storage is, as we showed with the oil side. But you have to consider what happens next. So several refiners with Sinopec and Petros China last month said that they were really reluctant to export oil products, even though they had a huge glut, just because pricing was a little bit better within China versus the external markets. But now with the new surge in flooding, with the slowdown in terms of just local demand, we do expect an increase in exports as the pricing gets worse domestically and things start to shift abroad. Now, when you look at what China has announced, they've actually announced a price increase in gasoline and diesel starting next month. And that's also going to impact demand, because now you're going to have an issue where the prices are going up. People don't have as much money. As we talked about in our economy show, things are really just slowing down within China, which is going to hurt inherent demand, especially as prices go up. Now, this is why we think there's going to be some competing issues and demand will remain a problem. And just to kind of put numbers to it, so product exports from January to July dipped about 2.7% and came in at about 37 million metric tons. Now, that's something that we do think it's low versus last year, but we do think you're going to see that turnaround, especially as we go through September and October, just because that demand locally is going to be a problem. But you have to look at Chinese imports of crude. So we did get a big step up, and you could see just going against the 5-year average, it's quite large. And the issue is going to be, where is that going? So when we look at it from the perspective of what the data says from the customs, they imported about 12.08 million barrels a day. Now, the 51.29 is metric tons, so it's just easier to convert it into 1,000 barrels per day, which is just a little over 12 million. So even though we've seen that increase, not all of it is going into refiners, as we've seen refiners really slowing down and paring back, which means that is going into storage right now. So now when we look at, okay, well, you just purchased 38 million barrels a day from the US, but you're taking this additional crude and putting into storage. Well, are you trying to arb the U.S.? Or is it just something to have a talking point when you sit down to talk about the trade deal and then you'll renege on the contract? These are things that we kind of go back and forth with how is this crude going to move into the market? And that's why, like in September and October, the inflow is really starting to show a huge slowdown, just because they do have that coastal glut. They have, ports have seen significant bottlenecks. So there is that glut that has to be cleared, which is why we do see that slowdown, which is only increasing through September and October. And that's where now we have to look at it. It's like, okay, well, China's slowing. You're starting to see some of that pare back. Well, what's happening in India? In India, this is where you can see where refinery throughputs were on a monthly level. The data just came out for July. And you can see they're well off the seasonal average. Now, there was obviously the big spike off the bottom, and there was talk about getting back to 85 to 93% and as high as 95% in specific areas. But as we had a resurgence of COVID, you saw that really get walked back. And now there's conversations that they're going to not really be able to even maintain 85%, but have to walk back to about 75% to even 70% to 65% in specific areas, which is just going to keep inherent crude demand very low, specifically in India, as we continue to see diesel demand, which is down now about 22 to 23% year over year locally. So now if you're not able to take this and push it into the market, well, where does it go? Well, it goes into Asian floating storage. So here you can see this is where Asian floating storage remains very elevated across any metric you want to use. And previously, it was pretty much all in China as India was really starting to absorb some of that, which is what that drop was when you start to see some of the normalization. As we see India starting to slow down, as we see China starting to slow down, you're going to have to see those September and October numbers really come down because storage is going to get expensive, which is why we come back to supply, where you have excess tankers, which we talked about in part one. Excess tankers means that you can get deals on rates, which means that maybe this oil Asian storage really doesn't go down. It kind of stays flat as the Middle East tries to compete and get more into the market. And just to kind of put it into some metrics here, the total volume was still 4 times the normal level in May, even though it walked back from the peak of 88.6 million barrels in storage, which was seen in June. Now, it was 88.6. It's now down to about 78 million. So you've seen about 10 million come off, which is reflected here. But as we're seeing more crude go onto the water, just as the OPEC deal starts to get unwound, more supply bleeding in, demand not really coming back, this is where we're seeing those issues. And when we talk about the issues, we really have to dig in a little bit deeper into India, gasoline and diesel exports. And this is why we wanted to look at, okay, well, what's happened over time? And you can see diesel exports, gasoline exports have been relatively flat. Diesel ebbs and flows, but the problem is the local demand remains very soft and storage is full. So, the question is, are you going to get into the market through exports or are you going to cut refiners? It's going to be both. And that's why we've seen traffic increase, shipments of diesel from Asia into Europe and into the Americas. And this is what we're seeing here, where total imports are down. But again, they're down because you're also seeing refined product demand down, which is becoming the bigger issue. And now just to put it into perspective of how far are they down, here's how far they're down. It's huge. And this is the huge drop. And there's nothing to see that is really going to adjust in the next, let's call it 6 weeks, just given the issues they're having right now with the COVID resurgence, issues in terms of industrial production. And then at the same time, you still have monsoon season, you still have other issues that are going to impact just total demand. Now, will it stay at this low? No, there will be a bounce. There will be some normalization as you try to see them right size their management of storage, not only on the oil side, but also on refined products. So this will start to reverse. But again, you can see just how big that drop was, which is why we do have that increase, or at least that stabilization at these elevated levels of Asian floating storage. And that's when you have to look at, okay, well, we talk about the US every Wednesday. So what's happening in Europe? And here you can see Europe starting to increase a little bit. Now, the problem is Europe is in a catch-22 where you're starting to get some normalization in some countries, even though France is starting to see a big increase of COVID cases, which is getting a little concerning. Germany had their spike, and you're starting to get this back and forth. So the numbers came in. We'll talk about them next week in the economy show. But the German, or I should say the European PMI numbers actually came down when we look at it July into August, which we expected and we think is going to get a bit worse, as we talked about in this the previous economy show, looking at toll miles in Germany and really kind of looking at, okay, well, toll miles are going down. So then clearly diesel demand's falling as well. So this is where we're starting to see a little bit of a slowdown in terms of refinery throughput, but we do have a huge surge of diesel, gas oil coming over from Asia into the Americas, into Europe, which is going to complicate because maybe it's cheaper to buy it from Asia instead of make it yourself, which is going to push oil in storage higher. And then obviously we keep saying it and we'll say it again and again, we're coming into shoulder season. So now as we kind of wrap up and look at what's happened with world oil demand, we have to consider what OPEC is saying when you factor in what are their demand estimates. So world oil demand they see in Q3 at 92.3 million barrels a day. Now, let's just touch on the U.S. for a minute. So they're saying that the U.S. is going to consume 20 million barrels a day of demand. Now, we're halfway through Q3, a little bit further past the midway point for Q3, but we haven't seen that kind of demand level. So in order to average that, we'd have to exceed that number to then back down into that number, which is near impossible. So that's why when we look at these demand numbers and we just take jet fuel for an example. I mean, if you assume jet fuel is 6 million to 8 million barrels a day and just the massive drop off of demand being cut by at least 50%, closer to 60, 70%, that's already a huge drop from where we were in 2019. So 2019, we averaged 99.7, and we're going to come in at 92.2, even though we have COVID issues, we have miles down, we have gasoline down, we have diesel down, we have jet fuel down. So this is why we remain concerned on 2020 estimates as we think some of these demand numbers get pulled back. And just to kind of put it into perspective as to, well, how can we get to 20 million? So refinery throughput is at 14.5. We've never really been above 14.7. So now you want to say, okay, well, we have to factor in imports, even though imports should factor into the way refiners are operating. So where is the additional fuel going? Where is that oil going? Because we've seen refiners actually reducing even further given the soft demand. So now we're going to get an acceleration of refinery throughputs declining through let's call it the end of August, and then as we get into September. So how do we close that gap? How is it possible to achieve those numbers? Just to give you an idea of how Q3 is going to be very difficult to hit, which is why some of these demand estimates are going to have to come down. And again, we talk about this in the EIA show. We highlighted in the economy show just how difficult it's going to be to close this gap and how demand really is struggling. And that's when then we take it into 2021. So we have our own estimates that we put together. Here you can see 2020, they're expecting an average of 90 million, which is, let's just say, about 9 million barrels a day decline from 2019 into 2020. But then we're going to get this big pickup, and we're going to have this growth that's going to normalize in 2021. Again, these are issues that we have with just how consumption has changed due to unemployment, work from home, flying. Where is COVID? Is there a vaccine? Do people feel comfortable? Do people have money to spend? These are all of the unknowns that when you look at just the data underlying it, we see some bright spots, which we talk about in terms of the recovery in shipping, which will go deeper next week in terms of the CAS index. And trucking remains that bright spot. But again, driving, total global miles remain soft. And then at the same time, industrial production remains problematic as we look abroad, which is why we remain very concerned that these numbers still remain overstated. And you're seeing that really in the largest producer, in the largest consumer, which is refiners. Refiners are saying, look, my numbers are terrible. Demand is terrible. My storage is full. I have to cut, which is going to take time to work through the system, which is going to make it very difficult to really see this growth. So thanks again for watching. I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.